Ladies and gentlemen, welcome back to our trader strategy meeting for the month of April. If you are new to the service, this is where we bring in our whole team and discuss some of the trading ideas, strategy, and perspectives that we may have for the coming months. And this is a pretty important time considering we are on the preface of earnings season and we've got a lot to discuss. So I'm going to jump right in and welcome in I'm going to bring in chart trader Brett Manning and talk a little bit about the big picture narrative. Brett, how are you?
I'm doing great, Jim. How are you?
I'm doing all right, man. So thanks for joining us. So we had some inflation data today and yesterday, a mixed read. We had hotter than expected PPI, but yesterday's CPI report was all right, I would say. So what's your overall takeaway now that you've seen these data points?
Well, I would say yesterday's CPI report was by far the worst one that we've seen. But I think that people responded to it as if we're on the verge possibly of a peak inflation. I'm going to talk about that in a second. But first off, big picture, super big picture, 30,000 feet. Inflationary pressures at this point, as we've heard over and over again from different members of the Fed and other central banks around the world, are clearly significant enough to absolutely force central banks to use monetary policy to try and stop inflation from growing further and more importantly to stop it from metastasizing into inflation expectations that become rooted into economic agents mindsets going forward, because that's how you get something that could be a multi-cycle inflationary problem. And really that's their job, and there's no question about it. That's what their primary objective right now is, not to make sure we stay out of recession. That's far inferior to the idea of cutting off a structural inflation problem. So, but the problem that we face as far as equities are concerned is monetary policy isn't really the source of the problem right now for inflation. It's reopening of global supply chains, it's undersupply of oil and gas, the war in Ukraine, and policy tightening isn't really going to fix any of those things. So they're going to have to undercut demand directly, and they're ready to do that. We should see a 50 basis point hike coming up in May, a 50 basis point hike in June. We might even see, I think Bank of America is calling for, or either Bank of America or Citigroup is calling for a third in a row 50 basis point hike in the following report. And all of this is being made a lot worse. And we've talked about this over recent strategy meetings, that China's zero COVID response is something that lengthens out how the supply chain problem is going to impact things. If they had kind of gone along with strategies in other developed nations around the world, they'd be past their Omicron wave at this point. Supply chains would be really healing. And China's the root of so many supply chains. And the fact is, they're just on the upslope for their Omicron wave, and it's going to be bad and it's going to take a while. And they're continuing to revert to lockdowns and shutdowns rather than a sort of manage and mitigate policy. So that's extending the time frame, which puts more pressure on the Fed and more pressure on other central banks. And of course, what we've seen is an upshot from the war in terms of driving commodity prices by supply side economics. So if there's one force that's working in the other direction, other than monetary policy, it's the substitution of services demand for goods demand. And that's a consequence of reopening the economy after the pandemic. One of the reasons why we're seeing such a problem with inflation now is consumer spending's been high, household savings has been high, but people have been spending their money on goods because they haven't been taking advantage of services, at least during the pandemic. There's not a lot of people going out to eat or going to movies or going on big trips, staying in fancy hotels, taking cruises. That whole side of the economy was basically shut down, but people still had savings and they were still spending. So they were all spending it on goods. And as we further reopen and the reopening dynamic becomes a really stable part of the picture, you see that demand shift from goods to services. And services don't really have a supply chain problem other than maybe the supply of labor. So that's something that should actually push back against inflation. But at this point, uh, uh, yesterday's CPI report, I think, was as bad as we've seen by any real reasonable measure. However, it could be the market was betting initially off of the reaction, and maybe a little bit again today with what the bond market is doing and equities. Although maybe that was, we're passing the sort of peak, because it's also coming up against the process of year over year comps being steeper on the back end. So, however, I would caution that just because we start to see CPI reports that are not increasingly more shocking than the last one every month doesn't necessarily mean that there's not going to be repercussions that eventually put us into a recession situation.
All right, Brett. So, with all that said, how are you positioning for such?
Well, I mean, first, let's cover what positioning is out there. The Bank of America Fund Manager survey was really interesting out yesterday. Showed a new all-time low in global growth optimism among large fund managers. So lower than we saw coming out of the 2000 top, lower than we saw during the global financial crisis. This is the worst reading that we've ever seen in something that goes back about 30 years. So, and it's not really been a contrarian signal. When we had prior lows, as I wrote about in my notes this morning, the market went down significantly after we hit those really big drops in global growth optimism. It doesn't have to play out that way. But right now, institutional money is positioning itself increasingly for the potential for a global recession. Global recession is now the number one biggest tail risk in the survey. We've got cash levels at somewhere between 5.5 and 6% of assets under management. That is kind of like battening down the hatches. So the institutional money is positioning for a global recession shift or at least a growth shock. Retail market participants, the kind of middle sentiment. AAI bears are basically dead center. The robo ratio that I talk about so much is pretty much in the middle of the range that we've seen over the last couple of years, where we've seen such a burst, such a craze around retail options trading. And retail options trading is still in a craze. We've seen both small trader call buying and small trader put buying sitting at extremes right now. So we've got a huge retail component in the market still, and we have institutional money very defensively positioned at this point. And if the institutional money is wrong, this could be the beginning of the next leg. But at this point, my bias right now is for a non-directional market, but one that's easier to trade from the short side than the long side. And that's how I've been acting. I'm short the S&P, I'm short the Nasdaq, and I'm long gold right now. And I see this eventually moving to lower lows for the year, but I don't really have much of a time frame there. I would just say the dynamic that I've seen and the way that I look about this is about motive behavior. The dynamic that I've seen so far this year, pretty much throughout, is sharp squeezing rallies that seem to wither and roll in afternoon trading and roll into grinding slow declines. And that's a bear market motive behavior in my experience. Bulls need to start seeing the opposite kind of dynamic where you have the downside moves are short, quick dips and shakeouts, and they turn gradually into slow grinding rallies. So when you see these really bolting rallies roll over in these just kind of steady grinding declines, that's the sort of thing you usually see in a bear market context. And so far, that's mostly what we've been seeing all year, including the last couple weeks. Um, if we start seeing the opposite, I'll happily start taking the other side of the market. But right now, I have been having a lot of success at waiting for the sharp rips to kind of top out and start to show me some red flags on the technical side on short-term time frames, and then getting short index instruments.
All right. Yeah. And you have been doing quite well in that. In fact, a lot of our guys have. I know Event Trader has been dabbling that on the short side as well. So we've really had some nice trading calls on the indices from you guys. Before I let you off the hook, though, Brett, I do want to ask you about the volatility we've seen in the yen. Have you taken a look at that and maybe what's causing that?
Sure.
Because even when we look at some of the flight to quality trades, the yen has been one that has been a staple in
hmm
that, but not so much lately. So what's going on?
Well, if you recall our last strategy meeting, uh, you said, "Is there anything upcoming that you see as interesting?" And I said, "A short in the yen."
Hmm.
And that was before this last decline. I didn't end up getting it on. I wanted to see a little bit of a different pattern, but the dynamic that I was looking at then is people were positioning for the yen to be a safe haven like it normally is. But in the situation that we have right now, Japan doesn't produce much of anything as far as raw goods. They have to import everything. And right now, this is the worst time in, decades maybe to be a country out on an island that has to import raw materials to maintain its economy. So I think they're really suffering from the standpoint of the combination of a depreciating currency and increasing pricing for energy and all raw materials.
All right. Well, then it seems as though there would be further downside in the end.
Could be. I mean, it's gotten really crushed, but
Well,
that's certainly the direction of trend right now.
all right. Well, why don't we bring in Event Trader at this time? I know you and Chart do your sentiment and flow show, and I know you kind of feed off each other there. But I know you've been active in the banking sector conference calls. I know Jeffries came out and you've given us an update there, and JP Morgan. So is it already setting the stage for what to expect from some of the other big wig banks that are coming out later this week, Gavin?
No, I don't think so. The problem with JP Morgan always coming out first is it kind of sets a higher bar for the rest of the group, as JP Morgan's usually one of the top performers. Jeffries always gives us that nice insight a couple of weeks ahead of time to really prep us for what we should be expecting on the investment banking side from equities and fixed income. So that had been laid out, but a lot of questions remaining around the traditional banking unit, and the read through being, of course, how's the consumer performing out there. The JP Morgan data that we were seeing, I don't think really provided anything completely surprising. I mean, we see mortgage applications down 25% year over year. Certainly, the rise in rates that we've been seeing impacted that. They were 24.7 billion, it was down 37% from the prior year. Mortgage loans themselves, that's for the originations. The loans themselves are down 3%. Looking at the card and auto area, revenue was down 8% year over year, primarily on strong new card account originations that led to higher acquisition costs, meaning that the bank's spending a lot to get these people online. The spend was still there. That was debit spend was up 21% year over year, which obviously shows people are putting the money to work at least. A lot of that was in travel and dining, the T&E section. So that should bode well for American Express moving forward. And, like I was saying earlier, with what you saw between Delta and Bed Bath and Beyond, was that change that we're seeing in the consumer moving from spending on things, stuff for the house, the Home Depots of the world, the Lowe's of the world, moving away from spending there to more travel and entertainment, which would be restaurants, airlines, and destination places, of course. So I think that's a theme that we're going to see that emanated from the JP Morgan call, and we're going to see that really play out as throughout the industry. So kind of positioning yourself for strong reports from the airlines and the Marriotts of the world and things like that, perhaps a little bit weaker on the Bed Bath and Beyonds and the Home Depots. So we've been seeing that playing out in the backdrop. Uh, Certainly on the selling part from some of the Home Depots of the world and everything, but look for that to continue to extend from what we were seeing from that JP Morgan report. And then just kind of keeping an eye out. Fees remain a little weak for JP Morgan. Obviously, with the environment getting more volatile, people are pulling back on their spending, or at least, plans for their businesses. They want to see what's going on with these rates. And that is going to continue for the next couple of quarters, leading to some question marks in the overall health of the economy. And that's kind of really the key theme that we saw emanate from JP Morgan as well, is that people are cautious out there. I just posted the CAS transportation index, and that showed a little bit of a decline in freight in the freight system, which obviously is the underlying growth for the economy. And that's all part of the Fed's plan to ease back the economy to a degree where inflation pulls back in. And then theoretically, we hit that little plateau where the pricing pressures ease and the economy picks back up. Now, that's going to be a very difficult area for the Fed to be able to very difficult plan for the Fed to produce. And that's really why you're seeing a lot more caution out in the markets there. Something, as Brett was pointing out, we'll see the choppy starts and fits in terms of, you might get a little bit of a strong economic data point here. People will jump in, start buying, and then you get that rollover as we get some other negative data points coming out. And that just makes for a very difficult environment to be able to invest as a long-term investor. And I think what that does is that leads to shorter holding periods for people. Their swings are going to be, people aren't going to wait around and just buy and sit in something and hold it. Uh, if they get a good run or a rally in something, they might look to cut a little bit earlier, and that's where you get the choppy market designation. Unfortunately, given the caution, there's a little bit more risk to the downside, as Brett was mentioning. We're going from arguably the most dovish Fed of all time to the most hawkish Fed of all time. Sans Volcker. But that's going to be a very difficult environment for people to be able to manage money in. And I think that there's going to be a couple of hiccups here and there, which will just be a bit of a drag on the market. So from my perspective, the way I'm looking at JP Morgan and the global economy playing out is that you could be patient and wait for good entries into names that you want. You don't have to chase names in this environment. I don't think that there's any signs that FOMO is going to be taking place. And that's kind of what I'm seeing early on from JP Morgan. I'm expecting even more cautious commentary from the other banks as they go through, Citigroup being a prime example with their hefty exposure to overseas currencies. That's going to be very difficult to manage in this environment. So until we see those things settle, no need to be all clear and just buying things. But I don't think that you have to run for the exits and go all into cash. The key thing from what I've seen early on in JP Morgan, some of the other earners, is be patient and wait for prices to come back to you.
All right. So is it safe to say, like chart trader, you're overall bearish in general, though?
Yeah, bearish to a degree. Not looking for a complete collapse. I have been leaning on the indexes a lot, but that's generally how I trade the indexes. I don't really use them for vehicles moving forward. Use it to offset potential losses in my portfolio against names that I'm not looking to guess the tops or bottoms in. From that perspective, I think you could put me a little bit more in the bearish camp, but certainly not a perma bear by any chance. I think that there will be times that you can go and buy, and there'll be a little bit of white knuckle buying because you will be at key levels. I think we're at a lot of key longer term trend lines in some areas, the XLF being one. And we're going to be watching that play out. It's at some point we could get a little bit more of a flush than what we've been seeing for that lower low. But I'd be a buyer on such a move. I wouldn't say I'm bearish as much as I'm trying to be patient and get better pricing.
All right. Well, you have done very well in your shorts, though, Gavin. So good stuff there. You've been pretty on point when you've been selling these and taking minimal risk at that. So definitely want to give you the golf clap. Except I won't do it here. So I want to bring in Trend Tracker Craig into our discussion here, and I want to piggyback on something that Gavin has been talking about, and that being the travel and entertainment theme. Now, I know you've been involved in Airbnb for a while here. At least I think you are still, right?
Yes.
Okay, so it's been consolidating pretty, in a fairly tight range, and now that we got a breakout technically through this congestion of moving averages, are you at the point of thinking about adding to it, or where do you stand here on this Airbnb, ABNB?
I continue to like it. I would, at this stage, I would prefer to add to Expedia, to be honest,
Mm,
because it's more reasonably valued. I like Airbnb longer term, but I think Expedia, EXPE could work better here in the short term just because it's trading at basically a market multiple, um, low to mid teen EBITDA multiple, where Airbnb is more of, one of these next generation, innovative, high multiple stocks that, it's still out of favor now. Obviously, the travel and market is red hot, so that kind of offsets that to a large degree. But Airbnb, it's something like 50 times EBITDA, 12 times sales, where Expedia, again, is, I want to say it's about 13 times EBITDA in line with the broader market. I like both. Those are my two preferred travel stocks that I'm long. I do like that exposure. I'm also in Kizu still, which is a lot more speculative and lower quality. But yeah, the Delta report this morning kind of confirmed what we all knew with respect to demand, the demand environment. They were able to surprise with a solid outlook for Q2 with respect to profits as well, despite the high fuel prices. But I'm also in Delta still. I've been in that one for like 5 years. But if I had to pick one more near term, I think it's Expedia, but I do continue to like Airbnb longer term as well.
All right, good stuff there. And I wanted to pick your brain a little bit about where you see the fertilizer stocks going. You've been all over this space, and a few of them are down a little bit today, but it seems like they are ripe for buying the dip candidates. So, where do you stand on that? Do you think there's a whole lot more upside there in these names, or getting a little cautious? Where do you stand?
I view this as a momentum inflation play. On the fertilizer side, among this commodity basket exposure that I've been starting to build out, it's more so a play on Ukraine. I think it's Russia and Belarus that account for 40% of the supply in potash. So there's it's kind of on the days where the headlines would seem favorable. In terms of the headlines indicating, peace talks are progressing, or maybe there would be a pause in the conflict. These stocks would kind of tick down on that because the supply disruption from Russia, Belarus, Ukraine is, I think, one of the big factors. We're seeing more concerns about food shortages, especially in the developing world. And these stocks, there's NTR. I know Blue Chip Scott has been trading CF, or he might be long CF. There's Mosaic. I think actually Gavin, event trader, is in Mosaic, MOS. And, unfortunately, the situation in Ukraine isn't going to be improving anytime soon, right? So I think these are fairly safe longs. And they're still all relatively cheap, mid to high single-digit EBITDA margins. There's a bear case on the NASDAQ that this inflation, either this cycle of inflation is going to be a lot stronger than people are expecting. It's not peaking out right now, or that even worse for the NASDAQ, that this inflation is more secular. It's not going anywhere anytime soon. That's the bull case for all these commodity stocks. So, I continue to like NTR. It continues to flirt with highs here. It's breaking out the last couple of sessions. I don't view these as I do when I have a technology stock that I really like for the long term. This is more of it's where the momentum is. It's what's working right now. So I continue to like it, but I'm not necessarily going to marry it. And when it comes to the earnings reports, I've over the years kind of avoided a lot of these materials and commodity-based stocks because there's so many variables um, at play that are hard to get a good grasp on that I can't control. But and the market has you got to trade the market at hand. So this is what's working right now. So I'm staying long.
All right, and I want to touch on some of this mega cap selling that we've seen. As you noted plenty of times, it's somewhat fallen out of favor, but you think it could be somewhat attractive. Why would that be?
Well, these stocks are, whether it's Apple, Microsoft, Amazon, Google, Meta, Facebook. Clearly, the money does not want to be in technology or growth because of this inflationary environment. Now, depending on which one you're talking about, they have different exposures. But something like Google, Alphabet, Google here is trading at a market multiple. If you look at EBITDA, maybe it's a slight premium. If you look at earnings, maybe it's a little over 20 times. And the split next week coming up, I think it's in late June, is a potential catalyst. You can make the case that, but these stocks are out of favor for a reason. Nobody wants to own tech, media. They want to be where it's more safe in terms of the inflationary environment. But from a long-term perspective, nothing has really changed. When we're talking about Google, yes, there's regulatory concerns. The EU is going to continue to come after them. The US is going to continue to come after them. But none of it is really going to impair the business, most likely. And you can't really find any more dominant franchises when it comes to Google search business, Android, YouTube, etc. From a long-term perspective, weakness is a buying opportunity, and there's a plethora of other ad tech stocks that are appealing. As you know, I'm long TTB, I'm long PubM, and there's a bunch of other attractive ad tech stocks out there, but they all don't look as good when they're compared to Alphabet. All of them, which are obviously a fraction of the value, fraction of the size, are most of them are still more expensive. So Google especially here seems to be attractive, while more positioning, and people just don't want to be long tech right now, but I think it is providing an opportunity in something like Google.
All right, and then we got that stock split coming up. You said in June, so like you said, that could provide a catalyst. In the meantime, maybe we can be patient and see it come in a little bit before jumping on board. So we got some time there in Google. And then the last one I want to touch on is Upstart. You got an update for us there?
Well, yes, I am interested in adding here. It was consolidating about the 50-day for a while, and now it's kind of broken down along with the NASDAQ. This stock continues to have a target on its back to some extent, and it's not without risk. I don't want to act like this is the biggest layup ever, but I really do continue to like it. I think it's about $8 billion valuation right now, something like 35 times earnings. And the setup is, again, seemingly very attractive into the next print. The guidance for the year on earnings seems quite conservative, and they've blown out earnings expectations pretty much every quarter. So I do like it down here. It's a very much misunderstood stock. And again, it is risky, but I continue to like it here on pullbacks, especially here under 100.
All right, and it seems to be at a fairly attractive level down here. It is up a little bit today, up 4%, so not doing too shabby. Gavin, did you want to jump in with a question for Craig?
Yeah, Craig, quick Quick question for you. You don't have to get too deep into the weeds on individual names, but overall, I know you always do a good job with that sheet that you provide and for valuation of some of the higher flyer cloud and tech names that have been that had such a strong couple of years in the past. Obviously, with the rising rates and the long-term duration assets being sold, they've been getting hit pretty hard. How's the valuation in general looking across the board for these names and going into this earnings season?
Well, the cloud stocks have pretty much come back to like pre-pandemic levels. I think on average, I can post an update on that, but on average, they are down to about 9 or 10 times sales for cloud stocks, which
That,
was
that that's near historical averages, right? 10 times, or would that
right,
still be high? Okay.
right. I think it's right in the range of historical, or at least a little below where it was just before the pandemic. Um, and the highest multiple stocks continue to be dominated by either recent IPOs or stocks that have really demonstrated that they're worth paying up for, something like a CrowdStrike or even a Cloudflare, which are both cybersecurity. Snowflake is down to 30 times sales, which is basically as cheap as it's ever been. Um, but yeah, the valuations across the board have gotten a lot more reasonable. I mean, there's a lot that were trading at 10 to 20 times sales that are more and now down in the single digits after having disappointed over the last few quarters. So, while the valuations have reset to attractive levels in general, it doesn't change the fact that nobody wants to own an unprofitable stock at 10 times sales that isn't producing cash flow in this environment, right? So, um, I mean, we saw a little bit of a renaissance for a couple of days before the market rolled over a couple of weeks ago. If the curve is flattening, you could make the case that if you want to own growth, that's the place to be. But if inflation is the biggest risk, then these stocks are still going to be out of favor, it seems like.
All right, Craig. Well, thank you for the updates on that one. I want to bring in Scalp Trader into the discussion here. And Damon, you've been somewhat quiet on the day trading side. What you been working on back there?
Hey, good afternoon. So yeah, I'm trying to recalibrate things and just get a sense of what the algorithms are doing, and also where the momentum money is flowing. So I've started to kind of ramp back up on the intraday analysis, and I've been posting some ideas. But I like to watch the price action for a period of time and just get a good feel for it, because there's a certain level of randomness to it right now, and so I'm just trying to get a sense of who's playing, how they're playing, how everyone's lined up. I feel like there's momentum money coming back into the market, and really just looking over the fence to see how everyone is positioned, and basically try to predict the opportunities in the future. But it is nice to see momentum money return. Everything had been unraveling for basically all of the growth stocks, had basically been in a downtrend for almost about 4 months, other than the 2 week bounce that we saw at the end of March. So things are starting to level off a little bit, it seems like, and momentum players are getting more comfortable getting back on the long side. And as importantly, there's a bit more bearishness as well. So you're seeing people shorting things. So it's creating more short squeeze opportunities. So seeing a return of the two-way market. I like kind of some of the action we're seeing on an intraday basis, and really starting to kind of shift my attention there.
All right. And you also have done a lot of work trying to identify themes out there. You got anything brewing in the high yield markets?
Yeah, so I think high yield is on the cusp of returning. As many of you know, I ran a core high yield strategy for years and years and years. I always had high yield positions, but when the Fed takes interest rates to nothing, prices on legacy deals, the price goes up and the new deals come out at really low yields. So basically, I sold into the uptick, and there was no new supply that I felt comfortable buying, because you knew once the rate hike cycle started, all of these names are going to get crushed. So you're starting to see a repricing of those type of opportunities. The legacy deals are starting to decline in price, which is pushing up the yield. Right now, I think there is an issue with issuers not being realistic about the state of affairs, the current state of affairs, and being somewhat shocked by the interest rates they're going to, or the coupons they're going to have to basically come to market with. So a few months ago, they were able to come to market with convertibles with maybe 2 or 3% coupons. I mean, now high yield growth, it wouldn't surprise me to start to see deals in the 8 to 9% coupon range pretty soon, especially for companies that are losing a lot of money. Traditionally, you've seen energy basically be the first to come to market with deals. Obviously, they're in a pretty good place right now, so they're not hitting the market. They're not forced to raise capital at 9, 10, 11% yields. So you'll start to see more financial companies, maybe some more technology companies. The agency REITs will definitely have to pay more. So yeah, I'm looking forward to both being able to collect the yield at 7, 8, 9, 10%, as well as the volatility that comes in high yield when you have market volatility and positions selling off, and being able to both trade these names and pick up core positions at lower prices.
All right. Are there any names in particular that you're looking at that you're doing some work on, or is it plausible to use the high yield ETF?
I personally prefer to go with individual names because with the intraday volatility or the short-term volatility, you're able to capture, I think, a little more yield, a little more price volatility on the individual names, and I like to dig down and do the research on those. So I'm not a huge proponent of using the ETFs. We purchased, I think last month, probably the first high yield position we've added to the portfolio in over a year, the DRH PRA, and that's sitting flat and ready to collect. I think it actually went ex dividend. We've already collected one distribution on it. There's one that I started a small position in. Personally, I'm not. It's a little funky, so I haven't put it on the site. But we've actually owned it before. I think we probably doubled or more than doubled our money in it, which was BPYPO, and it's trading around 2050 right now. It has a yield of just under 8%. The parent company was acquired, and so essentially the preferred has kind of been orphaned. I mean, it's still being paid, but there's not a company that you can look at every quarter to kind of see how it's doing, to connect the business trends and the business fundamentals to the actual preferred. My sense is this preferred will continue to be paid well out into the future, and there won't be any issues with it. But because of its orphan status, I haven't presented it as an idea, even though I really like it. It's yielding about 8%. And, interesting name, but it's one that requires a little more attention than a regular preferred or high yield instrument.
Well, it looks like it found a little bit of support around this area. So, is it safe for someone to dabble in?
Well, I mean, it's a high yield position. So, I mean, I would say that so personally, I purchased about a quarter of what I would normally buy in something like this because I typically don't buy orphan deals because they're just so much work to stay on top of. And so I've been very hesitant, even though I really like the yield. I think there's opportunity there. and I've been close to writing it up a couple of times. I'm just really hesitant to put it out there because when you get a shakeout, a market shakeout, this is the type of name that will go down further than other names that people are more familiar with and can track more easily. So stuff like this, I'll start a position and hope that things kind of implode. And I don't mind losing a little money to make money. And so, so the reality is that if rates continue to go up and we get some type of shakeout, another leg of shakeout in high yield, something like this, which is trading 2050, it could go to 15, and which I think would be an amazing opportunity. And it might happen at the open one day. It might blow through stops, slide to 18, and the next day gap down to the 1550 area. So there is a little, I mean, there's risk there, and there's risk in high yield. But that's kind of what I'm waiting for before really starting to scale up, get a bigger stake in this.
Is the liquidity somewhat of a problem in this name too?
Let's see. Yeah, I mean, a lot of high yield. I mean, that's actually part of one of the attractive components of it. So this one trades 7,000. It's traded 7,000 shares today. So when people put in stops at lower prices on things like this, you can see it flash down 2-3 points on a really ugly day in the market. And so for me, it provides the opportunity to be opportunistic. But if you don't have a strong stomach, then that might be a little scary.
All right, fair enough there. I think it's a good opportunity to maybe have a little bit of a roundtable discussion. And I know, Gavin, you had some questions regarding the energy sector and where people stand on that. So, Gavin, why don't I give you the floor?
Yeah, I was just kind of curious. Obviously, energy's been one of the leaders, given those sky high prices. So I suppose the discussion should start there. And then I'm just kind of curious as to how the traders might be looking at that space if they were, theoretically trading in it, or even if there were any names that they were looking at in particular. But Brett, starting with you, what do you see with oil right now? Obviously, you had the release by the Biden administration. A lot of things going on with production between OPEC. What's your thoughts on oil for the next couple of weeks here?
Okay, so first to put it in context for people who are maybe new to the service, I've been super bullish on oil since really the fall of really the late summer to fall of 2020. And I think Gavin and I together have both kind of been pushing that trade, especially coming out of in the latter half of the pandemic. And I got long oil around the 65 level when the Omicron wave broke after the first SPR news around Thanksgiving of last year, and I rode that all the way and closed the position above 120. And so it was really the culmination of a large time frame bullish kind of attitude about oil and several long positions, and that one being by far and away the most important and most productive. But that last move, when we moved from 90 to actually we tipped the tail up to 130, was really the parabolic kind of capping move in a long term move higher in oil. That doesn't mean it's really the end of this bull market. It may be, it may not be. I actually believe maybe it's not, but it certainly has been an incredible move, really from negative $40 a barrel to $130 a barrel in not a very long time. And really, that last move from 90 to 130 was super parabolic. It was a completely different kind of move. It was really sort of, helped along quite a bit by Russia's invasion of Ukraine. And it really kind of blew the rest of the positions out. And in my experience, when commodity markets have had a long trend that's moved up a long ways, and then some kind of event forces a real parabolic kind of addition to that trend, in my experience, has been a really consistent kind of dynamic that when you start to correct off of that move, you're going to at least revisit and undercut the sort of source point of the parabolic leg of that move. And to me, that really is the lows of the 25th of February, right around 90, and there was a shelf there that was there for about a week and a half. And I've noticed this dynamic a lot, and I still think that it's going to happen. I realize oil's at 103 now, up from 94 a few days ago. I still think it's going to see 88, maybe even 85. And at that point, I would probably start looking to push back on the long side. I want to see that cleaning move. I want to see it really purge things out. And with the lockdowns in China and with the SPR stuff and everybody battling back against it, I could certainly see us getting down to a bare bones CFTC spec long positioning situation and a dump of those stops under 90.
So with the EIA cutting its forecast, primarily due around China, Brett, right? And
Yeah, and it also could be part of this sort of recession possibility.
right, and as they said, a Volcker type recession, which I guess was going to have a lot of people kind of looking back at that 81, 82 time frame for the type of price action that we could see.
Yep.
So would you be shorting any of the oil names on that, Brett, or would you
Well,
kind of like?
I've been focusing on oil itself, and I took a shot yesterday and just a tiny one, really tight risk, and got away from it pretty quickly. And I'm kind of looking at it though. I'm sort of hunting it.
Now with the short too, would you also be looking at, given your thoughts around oil, I'm assuming you would also be willing to buy some of these names longer term on a pullback?
Yeah, I would say so. I mean, I would think at a certain point it's the shift from XOP to OIH. Just sort of philosophically, it's about uh, is it you've got a bunch of oil in the ground and that's getting more valuable, or is it we've got to start pulling more of this out and you're going to need services to do that? And we've had a paradigm for a while. Really, the reason for the bull market is because it's been XOP over OIH, because it's been no real increase in production, and that's been keeping the oil services names really under the gun, and it's been powering the companies with a lot of in ground oil that have really benefited from this. And maybe we're at a point where we're going to start to see that transition, and you start to shift sort of from an XOP dominance to an OIH dominance.
Do you see this as a possibly hot thematic play if we see that decline that you get going into the midterms? With the
Oh, I
idea
don't know.
with the idea that maybe the GOP takes control of the House, possibly the Senate?
I really don't think this is a partisan issue.
Okay. Okay. Damon and Craig, are you guys planning on doing any trading around the energy names? And if so, is anything in particular you guys are looking for?
I started a swing in Devon, DVN, late last week. A lot like the XOP and the XLE. It's just kind of consolidating near the highs, starting with a breakout. It's trading at 9 times cash flow. They have a shareholder friendly, I think I just missed the X date for the dividend, but it does yield like close to 7% as well. They have a shareholder friendly capital return program. They have a fixed dividend that's pretty small, but then 50% of the excess cash flow after the dividend is going to be paid out in a variable dividend. I don't like all these other commodity basket trades. I don't have any. I just view them as like a momentum following the trend. So
Okay.
I'm kind of just looking for a breakout here, but I don't have any more in-depth insight really than that.
How about you, Damon, with your trading style? Is there any setups that you're looking for in that space?
So KLX Energy, KLXE is a speculative energy name I've been following the past couple of years. $63 million market cap. They've done some acquisitions, and I've been tracking them, waiting for the turn in the energy services space. And so, obviously, there's a very strong demand to get that oil out of well, there should be eventually. There's definitely demand for the oil, and companies seem to be reluctant to spend on services right now, but eventually it should see money flow to that space. So KLXE is a company I'm tracking closely, waiting for the turn or indications that the turn is coming, because they have a lot of equipment, a lot of manpower, and if we get pricing pressure, which I would imagine that you'll see in the energy services, that business could turn around pretty rapidly.
All right, KLXE is on the screen right now, and looks like it found some nice support around $5. So you're waiting for more of a fundamental turn?
Yeah, I mean, so it's one of those stories where, like, literally every quarter, oh, it's just around the corner or just around the corner, and it seems like all of the services companies are saying that. I really just want some type of confirmation that we are approaching the turn, and that one's on the radar, and I've been holding off highlighting it until we get confirmation that business is actually ramping up.
All right. So, Brett, I want to bring you back in at least one last time here, and there has been some feedback about what it was that you saw in the S&P futures yesterday when you took the short around 4,400. Now, I will adjust the chart to whatever
44.
before, yeah, 44.44. I apologize. I will adjust the chart to whichever time frame you think is best suitable for this. But
I posted 2 charts just a moment ago.
oh, you did? Okay, well
See
then.
the chart post called reference charts?
Yes, I do. And it
Okay.
says, okay, so just so everyone is familiar, I'm going to uh, pull it up here. So there's two of them.
Yes.
All right. So I'm going to post the first one.
Okay. So you kind of toggle between the two either way.
Sure.
So we got the really extreme bounce off of actually the overnight bounce led to the squeeze that we got off the CPI data with the sort of peak inflation narrative. And like I was explaining earlier, we've seen a lot of really fast, sharp rallies that go through a process of flagging and then gradually kind of wilting. And there's a few patterns I look for to show me this. One of them, really well, that I like to take when I see a big squeeze, a sharp squeeze up to resistance and maybe poke through it and start to flush out some short side stops. And then we form a descending triangle. And I like the last bounce on the end of that, the narrowing end of that descending triangle, when you just break up through the sloped resistance and you short that and it comes back down to that descending triangle trigger line and then blows down through it. So this is kind of a variation on that sort of setup. It's not really a descending triangle. It's more I guess you could kind of call it like an intraday head and shoulders, but you could think of that as the neckline, the green line that I have drawn there. But you see that last bounce where I have the reddish triangle or the reddish rectangle. That was my
Hmm.
entry, and that's always what I like to do when I see it come down and hit the level, whether it's a descending triangle trigger line or whether it's something like this, you call it a neckline. The idea is you've got this this choice point in this pattern, and you see the big squeeze bar um, that initially broke to the upside that led to this intraday pattern. It's kind of like one of those eating the tail dynamics. If you break far enough down through that big squeeze bar, you're just going to see the dominoes tip and the whole thing is going to puke its guts out. And so when you have a neckline like that above that sort of midpoint of a squeeze bar like that, and if you shift to that second chart, you can see all of this is happening around pretty clear resistance points, like basically a 4-day range lows area that we had broken down through, and we're coming back up and testing that. So we overshot above that, above 44.50. So we blew out those short side stops that were involved in that chart. We've already got them out of there. So we've lost that ammo for the upside continuation. And now we're tracing out this pattern back to the first chart where you start to show this kind of flagging pattern, whether it's a descending triangle or the head and shoulders, where you've got this trigger point. The green line is really a trigger point. If we break underneath that, sort of there's going to be hell to pay because you're then going to hit all those orders that were attached to this idea of this pre-market upside breakout being this real change in the character of the market. And when you start to eat down through that, you start to make a lot of people really nervous. And eventually, especially in kind of a bearish sentiment environment, you're going to see a lot of people puke. So that last bounce, when you try to find support at it, bulls fight for it one more time and they pop it up into that 44.45 area. That gives me what I call a power position. If I short it there with 10 points of risk, then the most important thing to me in any setup like this is that my stop is at a point where if I'm hit, I know I'm wrong. It's a false setup. If this thing moves all the way well back above 44.50 at that point, I don't worry about it. I'm wrong. I'm not going to reshort that. It's dead. I was wrong about what I thought the pattern was. So I've got this real definitive falsifiable setup with a really manageable tight risk. So that last bounce, that pop up off of that support, that one last gas pop up is where I love to short things. I do it on all sorts of patterns. When we find this trigger line and we pop up, it puts me in this position where I've got tight risk, I've got a great ratio trade, I've got falsifiability on the setup, and if it then just gets anywhere near that green line again, I really know it's going to happen for me. And there's just no way the bulls are going to be able to support that one more time. And you've got this dominoes, because then you hit the trigger line, then you hit the bottom of that spike, and it just unravels, and you get this. So I mean, it was 75 points pretty quickly, on just a 10-point risk, which is a tremendous ratio. But
Yeah.
in a bearish market, when you have a pattern, you're blowing out short side stops up into resistance, and then you give this kind of pattern with this really falsifiable level, this really falsifiable setup, and this tight risk. It's just dead center of the type of setup that I like.
All right. And the good news is that you can re-listen to this and go through Brett's charts. I want to give you the timestamp on that. He posted it on the in-play page at 12:51. So if you're looking for the reference for those charts, that's where you can find it. All right, gentlemen, is there any stone left unturned that we need to address for this strategy meeting?
Nothing on my end.
I'm
All
good.
right. Then I will take the silence as a opportunity to wrap things up. Gentlemen, I want to thank you guys for jumping in and giving us some of your insight. Unfortunately, Blue Chip Trader wasn't able to make it for this round. However, he will be back this afternoon, so he will provide his insight when he jumps back on a little bit later. So have no fear there. But again, I want to thank all the listeners and you guys for joining us. It's been great as always, and we'll be back here next month. Thanks again.
Okay,
Thanks,
talk to you
Jim.
soon, Jim.